Hey there, it's John with Phoenix Desert Dwellings here with an October 2021 market update. We'll get right into the meat and potatoes. Supply is up at 93% since April. Everyone can clap. Then when you're done clapping, I'll tell you we're still down 11.5% since October of last year. No more clapping. So over the last 6 months, we've seen inventory levels rise pretty sharply. But the number of listings under contract has dropped 9%. That usually indicates a cooling of the market. We typically see that between April and October. So we look at some historical data that shows seasonal market changes. 2020 being obviously an exception to that. 2021 now, we're seeing that start to get back into the normal flux. Despite that seasonal drop, the number of listings under contract is still higher than any counts on October 1st from 2014 to 2019, which was between about 8,100 and 9,800. And that indicates a continuously strong market. It also shows demand notably higher than any other recent sellers markets. So we're still seeing that high demand, still low inventory. What is not seasonably consistent is the rise in listings between April and October. But as I mentioned, our total listing count is still extremely low. So compared to the last balanced market in 2014, the active listings count on October 1st was almost 22,000 versus this year is almost half of that. During the sellers markets after that, between 2015 and 2019, active listings on October 1st declined from 18,000 to just over 12,000. So despite that recent increase of 93% in supply, that's still 45% lower than pre-pandemic listings counts. Again, the demand just outweighs the supply, and that equals higher prices. There is still hope for some buyers. So while prices have continued to rise, that can theoretically be a good thing. So everybody wants a good deal. Everybody wants a great price when you purchase a home. But if you purchase when the market is in decline, you're almost certain to see your home value drop in the immediate or distant future. Right? Everything's going down. You think it looks good. You buy here. It keeps going. That is not good. So buying in that market, it seems overpriced, seems overvalued, but over a longer timeline, that may indicate that your value will continue to rise, right? Which we've seen over the last few years. So for instance, we had a lot of clients in 2019 that thought we were there. They thought we were already overvalued. They didn't want to pay those prices. They were kind of thinking we might be hitting a bubble. And so they pumped the brakes. They held off, obviously moving past 2019 into last year and this year. They kind of missed that boat, right? Values continued to rise. They tried to time the market, I suppose. I don't recommend that. For everyone else, right? Additionally, we're starting to see rents continue to rise. So they actually just announced today some new numbers that average rent was $2,320 a month. Crazy. Median rent price of $2,100 a month. So from a buyer perspective, affordability index, you're still looking at 2 to 3% interest rates. That's historically low, which indicates still a good potential time for you to buy, right? I'll use an example, right? As we start to put all that together and how interest rates impact versus that sticker shock and the price tag of a home, which is the first thing you probably think about. So example is, we're going to use some fixed numbers for this. So we're going to assume a 5% down payment, an average of property taxes and insurance, and no HOA or anything else like that. So a $400,000 house at 3% interest, you're looking at approximately $2,034 a month mortgage. That same house at $400,000 at a 5% interest rate, same numbers, is going to be $2,472 a month. That's a $438 difference just from that increasing interest rate. So assuming those interest rates go up as prices go down, maybe the market's really cooling off, supplies rise, whatever, right? And that same house is now $325,000. At 5% interest, your monthly payment is back down now to that $2,036. So you need to see, in this scenario, a $75,000 decrease in the value of this home at a 2% interest increase to get that same monthly mortgage payment. So I'm looking at that scenario though, and I'm seeing a lot of bad things despite the lower price tag, right? You're obviously paying the same amount in both scenarios, but you're paying more interest and less principal. That is bad. You're also back to the point that you just saw a $75,000 price drop in this house, which is likely due to a market decline, which means your value may continue to drop. Also not a good thing. That'll limit your chances for a refinance, for resale. It's just not a good position to be in. So good lesson is, right, look at the big picture. Don't try and time the market again, but make educated decisions that make sense for you and are best for you now. And looking at that maybe 3 to 5 to 10 years down the line, is that still a good decision? And did you make an educated decision? So if you have any other questions or you want to talk more about the market, give us a holler.